Exemption for dividends and profit distributions from foreign juridical persons based on participating interest. Under the UAE corporate tax regime, dividends and other profit distributions received from foreign juridical persons are generally exempt from corporate tax if the recipient business holds a participating interest in the foreign company. A participating interest refers to a significant and long-term ownership interest in the shares or capital of a foreign company, referred to as the participation, that provides the owner with some level of control or influence over the activities of that company. This exemption is designed to ensure that businesses are not doubly taxed on profits that are already subject to tax in the jurisdiction where the foreign company is based. For a business to benefit from this exemption, the ownership interest must meet certain specific criteria outlined below. These conditions ensure that the exemption applies only when the participating interest represents a genuine and substantive involvement in the foreign company. 1. Criteria for a participating interest. A participating interest exists when all of the following conditions are met. A. Ownership interest. The taxable person must have an ownership interest of at least 5% in the shares or capital of the foreign company. This interest must be held, or intended to be held, for a minimum period of 12 months. The 5% threshold ensures that the ownership interest is substantial enough to grant the holder a degree of influence or control over the foreign company's activities. B. Entitlement to profits and liquidation proceeds. The taxable person must be entitled to receive at least 5% of the foreign company's distributable profits and at least 5% of the company's liquidation proceeds. These rights ensure that the participating business has a legitimate stake in the financial performance of the foreign company. C. Asset composition. No more than 50% of the assets of the foreign company, the participation, can consist of ownership interests that would not have qualified for exemption if they were held directly by the taxable person. This condition ensures that the foreign company is not primarily an investment vehicle, but rather an active company with meaningful operations. D. Subject to tax requirement. The participation must be subject to corporate tax, or a similar tax, in the jurisdiction where it is based, at a rate of at least 9%. This, subject to tax, requirement ensures that the foreign company is paying tax on its profits, income, or equity at a rate comparable to the UAE's tax regime. The foreign company meets this requirement if it is subject to tax in its resident country at a statutory rate of at least 9%, or if it can demonstrate that it is effectively taxed at a rate of at least 9% on profits or income. E. Ownership instruments. The participating interest can take various forms, including ownership of the following types of instruments: ordinary shares, preferred shares, redeemable shares, membership and partner interests, other types of securities, capital contributions, and rights that entitle the owner to receive profits and liquidation proceeds. Additionally, a participating interest can qualify for the exemption if the historical acquisition cost of the ownership interest is AED 4 million or more. This ensures that the exemption applies to significant investments, regardless of the percentage of ownership, provided the investment amount is sufficiently large. F. Exclusion of deductions for dividends. If the foreign jurisdiction's corporate tax laws allow the foreign company to claim a deduction for the dividends or other distributions made to the taxable person, the participation exemption will not apply. 2. Example of participation exemption application. Example 11. Exempt income from a participating interest. J LLC is a UAE resident company that purchases a 10% shareholding in K LLC, a juridical person based in country A. K LLC is fully subject to tax in country A, and J LLC purchases the shares for AED 1 million in the tax period ending 31st December 2025. This 10% shareholding grants J LLC the right to receive 10% of K LLC's distributable profits and 10% of the liquidation proceeds, if K LLC is liquidated. In the tax period ending 31st December 2026, J LLC receives AED 14 million in cash dividends from K LLC. As J LLC holds a participating interest in K LLC, these dividends are exempt from corporate tax under the participation exemption. In the tax period ending 31st December 2027, J LLC sells part of its shareholding in K LLC, reducing its stake to 3%. The disposal of the shares is also exempt from tax under the participation exemption. However, in the tax period ending 31st December 2028, J LLC receives AED 3 million in cash dividends from K LLC. These dividends will not be exempt from corporate tax because the conditions for the participating interest are no longer satisfied. Specifically, J LLC no longer holds a 5% or greater ownership stake in K LLC, and the acquisition cost of the shares is below the required AED 4 million threshold. Additionally, J LLC is no longer entitled to at least 5% of K LLC's distributable profits and liquidation proceeds.